What if you could peek into the future of the stock market? Vanguard's latest forecast offers precisely that, a glimpse into potential trends and shifts that could shape your investments. There's a lot to unpack, from the impact of persistently high interest rates to the rising allure of bonds and the nuanced predictions for stock returns. So what does Vanguard say the market outlook looks like? Well, let's see. Navigating the financial world can often feel like steering through a stormy sea of unpredictable waves and hidden currents. For investors, having reliable tools and insights is essential. Vanguard's annual Economic and Market Outlook Report serves as one such tool, acting as a valuable compass to help investors understand potential market directions and make informed adjustments. Their annual forecast results are based on extensive research and analysis by economic and market experts. They shift through vast amounts of data, examining historical trends, current events, and possible future scenarios. This detailed analysis is then translated into actionable information for investors, providing clarity in an often murky landscape. The report covers several core areas of the economic landscape. For stock market trends, it looks at potential returns for various asset classes, such as stocks and bonds. They also consider corporate earnings, valuations, and investor sentiment to project future performance. Regarding gross domestic product, the report predicts global and individual economic growth or contraction, directly affecting corporate profits and stock market performance. Interest rates, manipulated by central banks to influence economic activity, are analyzed for potential changes. These changes affect borrowing costs for businesses and individuals, with lower rates potentially boosting stock prices and higher rates having the opposite effect. Inflation, the rising cost of goods and services, is another critical area as it erodes purchasing power over time. Vanguard's forecast on inflation trends help investors understand how much their investments need to grow to maintain their value. Their predictions are crucial for investors making informed decisions. Understanding projected stock market trends and economic factors allow them to adjust asset allocation by tailoring portfolios based on predicted performances of different asset classes. For instance, anticipating slower growth might increase bond investments for stability. It also helps manage risk exposure, as investors can implement strategies to mitigate risk, like diversification or hedging. Lastly, setting realistic expectations based on potential returns helps investors avoid unrealistic hopes and set achievable goals. Now, let's look at the persistence of higher interest rates. After years of historically low rates, central banks are raising rates to combat inflation. While this shift might seem a temporary problem, Vanguard suggests we may enter a new normal of elevated interest rates. Central banks kept interest rates low for more than a decade to stimulate economic activity following the 2008 financial crisis. While effective in the short term, this policy led to rising asset prices and inflation. To curb inflation, central banks are raising rates, making borrowing more expensive. Higher interest rates directly impact borrowing costs for both individual and businesses. Mortgages, auto loans, and credit card debt all become pricier, discouraging excessive borrowing and encouraging saving, which can lead to slower economic growth. Consumers might also reduce discretionary spending, affecting businesses that depend on it. Traditionally, higher interest rates pose a challenge for stock markets. When bonds offer better yields, investors shift their money from stocks to bonds, potentially leading to stock price declines. However, Vanguard sees a silver lining. While near-term market volatility is possible, higher interest rates can benefit long-term investors. Bonds become more attractive with higher rates, providing a potential hedge against stock market downturns. Vanguard predicts significant increases in bond returns compared to the era of low rates. Additionally, higher borrowing costs can push companies to operate more efficiently, potentially leading to more robust financials and higher stock valuation in the long run. Investors need to adapt their strategies to this new environment. Rebalancing portfolios might be necessary to maintain desired risk profiles, which could involve increasing bond allocations to mitigate stock market volatility. Focusing on companies with solid fundamentals and sustainable growth potential can be wise, as these companies are better positioned to withstand higher interest rates. Maintaining a long-term perspective is crucial. Higher interest rates are likely to derail the stock market's long-term growth, so investors should remain disciplined and avoid making emotional decisions based on short-term fluctuations. You can also be open to investment shifts. For over a decade, higher returns in the stock market overshadowed the humble savings account. Near zero interest rates meant leaving money in a savings account offered little benefit. But with interest rates climbing, this dynamic is changing. Savings accounts now provide more competitive returns, offering a haven for those looking to preserve their capital. This shift benefits individuals with shorter investment horizons or specific savings goals, such as a down payment on a house. To grasp the magnitude of this shift, consider the stark contrast between the current environment and the past decade. For much of the 2010s, interest rates were near historic lows, pushing investors to seek higher returns in the stock market. Rising rates make savings accounts a more attractive alternative, especially for risk-averse investors. This evolving interest rate landscape presents opportunities and challenges for various investor profiles. Individuals saving for long-term goals or those with low risk tolerance can benefit from the improved returns of savings accounts and certificates of deposit. For those nearing retirement, these safer options provide much-needed stability. Professional money managers who manage client assets face balancing risks and returns in this new environment. They may need to adjust their asset allocation strategies, increasing investment in bonds and other fixed income instruments to mitigate market volatility. Identifying companies with solid fundamentals that can withstand higher interest rates also become crucial. The rise in interest rates don't diminish the importance of stocks for long-term wealth creation, but underscores the value of diversification. A well-diversified portfolio that includes a mix of asset classes, stocks, bonds, and possibly even alternative investments, can provide stability and help investors navigate market cycles. The key is finding the right balance between risk and return that aligns with individual goals and risk tolerance. While the lure of higher stock market returns remains, the improved returns offered by safer alternatives are worth considering. By understanding the changing interest rate environment and adjusting their strategies accordingly, investors can capture the opportunities presented by this new landscape. Vanguard sees a bright future for fixed income investments for several reasons. First, higher yields are making bonds much more attractive. With rising interest rates, bond yields offer more competitive returns on fixed income investments. Vanguard forecasts bond returns could rival stocks over the next decade, making them a compelling option. Bonds also provide a buffer against stock market volatility. Traditionally, bonds show lower volatility compared to stocks. They also help mitigate portfolio losses and offer stability when the stock market dips. This diversification is particularly valuable for those nearing retirement or with a lower risk tolerance. Moreover, bonds provide a predictable income stream through regular coupon payments. This steady income can be especially beneficial for retirees and income-focused investors looking for reliability. Now, Vanguard predicts significantly higher returns for bonds over the next decade compared to the low-yield environment we've seen recently. This shift again makes the classic 60-40 portfolio, 60% stocks and 40% bonds, an attractive option. And, well, the 60-40 portfolio provides several benefits. It offers diversification and risk management by not being overly reliant on any asset class. This balanced approach has historically delivered consistent and moderate growth, making it suitable for investors seeking a balance between risk and return. The mix of stocks and bonds also helps reduce volatility, providing a smoother ride through market cycles. While the 60/40 portfolio is a solid strategy, it's not a one-size-fits-all solution. Investors should consider their circumstances, risk tolerance, and investment goals when determining asset allocation. Younger investors with a longer time horizon might tolerate a higher stock allocation for more significant growth potential. So why should you also focus on stocks? Well, you see, Vanguard also predicts moderate growth for the US stock market over the next decade, with expected returns ranging from 3.4% to 5.4% annually. This is a notable decrease compared to the stellar returns of recent years, reflecting concerns about high valuation in specific sectors of the US market. One of the main worries is that some US stocks might be overvalued, meaning their current prices might need to reflect their true earnings potential accurately. This could lead to future price corrections. However, Vanguard suggests looking beyond the usual large-cap US stocks to find potential opportunities. Emerging markets are highlighted with solid return potential over the next decade. With their faster growth rate, these economies are expected to outperform developed markets like the US. Vanguard forecasts returns for emerging market stocks to range from 6.0 to 8.0% annually, offering a compelling growth opportunity for investors willing to take on more risk. Closer to home, US small-cap stocks are identified as another area with potential for above-average returns. While small-cap companies are inherently riskier, they can offer significant growth potential. Vanguard predicts returns for US small-cap stocks to range from 4.8 to 6.8% annually, making them a consideration for investors seeking long-term growth. For those looking for further diversification, Vanguard recommends looking beyond the US. The forecast for global stocks, excluding the US, is optimistic, with projected returns ranging from 6.8% to 8.8% annually. This makes non-US equities an attractive alternative to the US market, especially for those wanting to mitigate risks associated with investing in a single geographic location. While these predictions highlight potential opportunities, it's important to remember that past performance doesn't guarantee future results. Investors should carefully consider their risk tolerance and investment goals before making decisions. A balanced approach, incorporating a mix of US and non-US stocks, large cap and small cap stocks, bonds, and other asset classes can help navigate the evolving market landscape. While near-term returns might be lower, there is still potential for solid long-term growth. By understanding the risks and opportunities presented by elevated interest rates, investors can position themselves to capture the potential of diverse asset classes and market beyond the familiar US large-cap space. And it's as simple as learning from the past. In 2014, Vanguard predicted a modest global recovery with low interest rates sticking around for a few years. They expected continued issues with unemployment and debt, along with lingering policy uncertainties. The forecast warned of potential volatility in specific equity markets as the Federal Reserve began unwinding its quantitative easing program. However, the past decade unfolded in ways that challenged many of these predictions. While the global recovery didn't happen, it wasn't uniform. The US economy, for example, experienced robust growth, defying expectations of a slower pace. Initially expected to stay low, interest rates gradually increased due to inflation concerns. Reflecting on the past decade underscores the unpredictability of financial markets. Events like the 2016 US election, global trade tensions, and the unprecedented COVID-19 pandemic significantly impacted the global economy and defied pre-existing forecasts. These events serve as a reminder of the market's inherent volatility and the challenges of making accurate predictions. Despite the difficulty in predicting exact market trajectories, Vanguard's annual report offers value through its rigorous analysis. Investors gain insight that inform their decisions by examining data and pinpointing potential risks and opportunities. Although Vanguard's 2014 outlook wasn't perfect, it did highlight critical concerns such as market volatility and potential overvaluation in specific sectors. The most crucial lesson from the past decade is the importance of adaptability. Markets are consistently evolving, and investors need to be flexible, adjusting their strategies as new information and circumstances arise. Maintaining a long-term perspective is essential. While short-term volatility can be unsettling, focusing on long-term goals and staying disciplined helps investors navigate market fluctuations. The past decade has shown the limitations of trying to predict the future. However, well-researched forecasts still hold value. Understanding potential scenarios and their influencing factors allow investors to make informed decisions and prepare for various outcomes. While not a definitive guide, Vanguard's annual economic and market outlook provides a valuable framework for navigating financial uncertainties. So now, how do you plan to adjust your investment strategy based on Vanguard's predictions? Comment down below. And as always, leave a like, subscribe, and turn on the notification bell.